Hello, what I'd like to do in this video is discuss the second deliverable for the project, which is to upload the depreciation schedule for the project. Now once you've done this, it's going to be a piece of cake to finish the third deliverable, but I'm going to caution you that there'll be a third upload required to get full credit. So even if you do the third deliverable as part of the second one, you're going to need to upload it in the spot in Canvas. So let's go to the worksheet that we put together already. And this portion of the investment worksheet, or of the project, the investment worksheet, you've already done. And we've got three categories of investments: property, the greenhouses, irrigation equipment, and working capital. And recognize that property and working capital are not deductible. They're not depreciable, which means they're not deductible. So let's go through and discuss the depreciation calculation for the greenhouse and the irrigation equipment. Now, in a very complex project, this might be done on a separate worksheet, but because this is such a simple project, we're going to do it on the same worksheet. So right below this investment worksheet, I have a depreciation schedule. And you notice that property and working capital are not being depreciated. Now I have a 7-year makers table for the depreciation for the greenhouse and for the irrigation equipment. Now there was nothing stated as to the depreciable life for these two in the prompt, and you're probably not going to find anything in the makers write-ups about whether it's 3 or 5 or 10-year property. So you're going to have to use default of 7-year makers. If it's not in any of the schedules, it defaults to 7 years. Now I can live with the greenhouses being 7 years makers. Irrigation equipment, in reality, probably are a 3-year life asset, possibly a 5-year life asset. I threw in this 3-year makers table just to, if you wanted to do a what-if analysis as to what would happen to your performance variable, your internal rate of return or present value, if you changed the depreciation life from 7 to 3 years for the irrigation equipment. That could be a what if that you would want to do. In any event, you basically multiply the depreciation, which is, or the investment amount, so $160,000 for the greenhouse, $30,000 for the irrigation equipment, times the percentage. That is your depreciation for the greenhouse. Sanity check as it has to add up to the 160. Irrigation equipment, sanity check as it has to add up to the 30,000. These are our individual depreciation components. You sum them up. This is what I'm looking for you to have as your deliverable. Now once this is done, you can turn in deliverable 2, but basically the project is ready to go. And the reason I say that is if you look at our master after-tax cash flow worksheet, we can pull our investments from the investment depreciation worksheet, that total column, our revenues from the revenue worksheet, our expenses from the expense worksheet, and we can get a before-tax cash flow including investments, and that's going to give us a 16.2% IRR. That's my target. Now notice I have the salvage value in here. Salvage value comes from this number right down here. Sorry, right over here. And it's the salvage value on the property sale, on the value of the greenhouse, and on the working capital. You're going to recover the working capital. I'll explain working capital further. I'll discuss it a little bit right now, but it's basically money you need to run the business. And so if you think about the current assets and current liabilities, it's basically the cash you need to pay your current liabilities. And so as you get to the end of a project, you recover all of your working capital. You can pull it out. But in addition to spending this money on hard assets, you're going to need this money on, I'm going to call it soft assets because it's cash, just to make sure you can pay your payables. Okay, so now we have this internal rate of return. I like to back out my investments. And the reason I like to back out my investments is because I incorporate my depreciation. So this column here, G, excludes the investments. And I have my depreciation I pull off of the investment depreciation worksheet. That's what we just calculated down here. And we take our before-tax cash flow, excluding investments minus depreciation, to give us our taxable income. And then we compute the taxes on the taxable income, which is basically the tax rate from our input worksheet. This is our regular income taxes. I like to split out the depreciation recapture just to show that it's different. Sometimes there's a different tax rate on depreciation recapture because it's a long-term investment. So this is based on the salvage values. That's going to be the salvage values right here. This one primarily. Exclusively this one. This is the greenhouse salvage value. So we have a total tax column. It's just the sum of these two. And our after-tax cash flow column. That's the holy grail. That's what we're looking for. And for this particular project, at least for the base case, I show a 12.7 after-tax internal rate of return and a present value of $22,000. So again, what you're looking for this second deliverable is I'm looking for you to have this number here. However, once this number is done, you basically can do the rest of the project and wrap it up. So I'm going to put a slot in Canvas for deliverable 2. I'm also going to put a slot in Canvas for deliverable 3. I'm going to make it a page because I'm going to add another video that will discuss sensitivity. But I'm not going to do it yet. I'm going to wait about a week until these first two, you've had a chance to digest these first two deliverables. And you can also get the final answer with what you have right now.